Gentlemen and ladies, yep, it's the market sniper coming at you on indices and the weakness season. So last time we spoke, we talked of the structure here being downside continuation and this being the face slap of a new trend. Following a melt-up period where you saw a big move up in the indices very, very steeply. A blow-off moment and that you had exhaustion gaps, continuation, another gap, and your slap in the face, which I tend to say is the first sign, the first tremor of the change in trend. And this is where I draw typically a red arrow and say this is then weak bulls late reaction, buying the damn dip, grind buying, failing to make the new high, and then you get the continuation to the downside. Note you had excuse me, the downside gap here. You also had a downside gap over there. Very capitulative price behavior. The last time we spoke on this channel, we were looking at this part, and I was suggesting that this was going to be continuation period, that you'd get potentially a rally and then a sell-off, and that you would eventually at some point break through this lower grind line to the downside, which has occurred now on the Dow. So we're looking at the Dow Industrial Index. This is a 45-minute time frame, and you traded in and around the 24.5, 24.4 over here after the initial break. Note how you got the initial break, return move, gap down, sell-off period. Then you get the rebound. That's once again the dip buyers and the dip buyers again, but they're slowly being bled out. That money's coming in. Now you've got a grind line across the bottom here and you've spilled through it. And that's probably going to hint to new lower lows. You may get a once again, whenever you break a grind line, and you'll learn about grind lines if you come to our webinar on the 12th of April. In more detail, you'll learn about it on our program. There will be an offer for the program on that webinar. It's the last time I'll be doing the 7 great mistakes that traders make and how you can avoid them by being more self-aware and identifying them, and also the 3 great gifts that you're not using that could make you a wholesale better trader. And having method, we're seeing it on the cryptos, the guys that have held on into a bear and kept buying long into the bear just get routed. Recognizing the bear trend, taking occasional judicious shorts and protecting your capital is the difference between actually gaining money and those that have lost 70%. And in the same way, it applies to other markets as well. Method matters. So on this side, you would be biased to short, and you would just be that little bit luckier. Not easy. Trading's never easier, but instead of it feeling like the market always hates you, you're suddenly moving with the tide. You're swimming downstream with the river. You're not knocking yourself out trying to swim upstream. Anyway, enough of that. Down break. You'll get a little bit of a think, because this is a classic support and resistance dilemma. Are we going to run a new low? And often you just do, and then you get a rally there. So the guys that are late to the short will short here, although the spill began right up there. So it's late in the current spill, although it's not late in the trend when you think how long we've been going up in terms of the indices. So what you probably get is you could just dip through here, and then you get a little bit of a return move rally, but that once again can just set up further shorts. So overall, you need to be asking yourself, in the next week or the next 2 weeks, is this index going to be higher or lower? I'm in the lower camp. Once again, this is a probability based assessment. We can always be wrong and have been inaccurate. It's about being on the correct side on more occasions than on the wrong side, and also to get that risk reward ratio really in your favor. That's the value of the squeeze that you got right down here, really tight on that. You could have had stops over here with your first short. Your return move never had enough to make the new high. That's much tighter than having, for example, a stop there or there. That allows you to trade greater size. That immediately means you're in good money here, 5, 6, 7 times what you risked, and you can sit through the rally without getting emotional. In other words, trades that move strongly and violently in your favor very early after you've been triggered into them are the safest ones, and the ones that end up being the ones that make you the bulk of your profits. Rarely is it that you go into deep loss, you hang on, you hodl, you hold, and then it comes back and then goes to the moon for you. It just doesn't happen like that. There's very few professional traders that'll tell you that. Anyway, that's it for now. Look out for possible further lows. This is going to echo through on the the SPY as well. That is your S&P. The US indices are the fluffiest right now in terms of my view, but if we take a quick look at the Amex version of the SPY, we'll quickly have a run past that just so that you've had me take you through both indices. And this has saved an old draw where the market has since moved this high, spoiled the SPY from being a good structure. So that's why we talk first about the Dow. The fact is you made a marginally higher high here in this case. So I'm going to remove that line. But they are highly correlated, and you've seen similarly here a squeeze has led to downside continuation. Just the structure is not as good as what we saw on the Dow. So we trade our favorite pattern always. It's got to give us what we want. You can learn all about that pattern by popping on to our free webinar and getting an offer. Only if it suits. Trading is not for everybody, and this method you have to have an idea that it suits your personality and style. But there again, down, and this one has already run the previous low. So in that sense, the SPY is almost higher beta. It went a little bit higher on the high side, but it's already gone a little bit lower on the low side, and this is far from a bull reaction. So you could very easily, normally if you want to go revert back bull, you would have a strong reaction that straight away starts taking you away. These two candles, while admittedly only 45 minutes a piece, this is indecision. What you often get here, if you don't very quickly get something impulsively taking you back up, is you get continuation. You get a weak grind up like a bear flag, and then you get a nice smash down into the end of the session for the US. Bear in mind it's thin trade day. Most countries, I suspect, will have Easter holiday off. We do over here. I don't think the UK markets are open at all. So you could get a grind here, and then you start the next day, or you finish the session with a slap down and you end up going lower, and then the next low you're eyeballing is down at this level. But it's the Dow we like best, and that's the one I was showing you. And that is what we've got for you. So I hope you enjoy that. Share a like. Be cautious if you're holding US equities. Be cautious if you're holding equities generally. It's also not the season to be leveraged long in equities. There will be a few special cases, but generally think very hard about how bad you want to be long. Remember, trade with a flow. There is a reversion in the flow. Tend to bias to the main macro trend in terms of activity. So either play defense and get out of equities, or be well covered, or even consider judicious shorts if you need to hedge against long-standing positions you want to hold on to. None of this is advice. This is just an opinion, and take it for what it's worth. And enjoy your trading. And see you on the webinar. That's 19:30 on the 12th of April. That's next Friday, not this Friday coming, the next.